Gold is on the move. It's April 14th, 2025. The markets are buzzing. All eyes are on gold. Why? Because today could determine whether gold surges to new highs or faces a sharp correction. The stakes are high, investors are watching, traders are on edge. The yellow metal has been on a tear. It's up over 10% in the past month. Year over year, the gains are even more impressive at 46%, but past performance is no guarantee of future results. The question on everyone's mind is, what happens next? Several factors are at play. Geopolitical tensions are simmering. The US-China trade war is far from over. Economic data is sending mixed signals, and the Federal Reserve is stuck between a rock and a hard place. In this volatile environment, gold has emerged as a safe haven asset. Investors flock to gold when uncertainty reigns, and right now, uncertainty is the name of the game. But how long can this rally last? Let's delve into the factors driving gold's price action. The US-China trade war is back in the headlines. After a brief truce, tensions have flared up again. The Trump administration has slapped tariffs on billions of dollars worth of Chinese goods. China has retaliated with tariffs of its own. These tariffs are a form of economic warfare. They are designed to protect domestic industries and punish rivals, but they also have unintended consequences. Tariffs drive up prices for consumers. They disrupt supply chains, and they create uncertainty for businesses. The trade war is inflationary. It's also bad for global growth. This combination of inflation and slowing growth is a recipe for stagflation, and stagflation is good for gold. Nitesh Shah, an analyst at WisdomTree, calls gold the ultimate hedge in this environment. He argues that gold benefits from both inflation and economic uncertainty. The Federal Reserve is facing a dilemma. Inflation is still too high, but economic growth is slowing. The Fed wants to raise interest rates to combat inflation, but it also wants to cut rates to stimulate growth. The Fed is caught between a rock and a hard place. It can't do both. It has to choose, and its decision will have a major impact on gold. Higher interest rates are generally bad for gold. That's because gold doesn't pay interest. When interest rates rise, investors can earn a better return elsewhere. This makes gold less attractive. But lower interest rates are good for gold. That's because gold becomes more competitive when interest rates fall. Investors are more likely to hold gold when they can't earn a decent return elsewhere. The market is currently pricing in a 90 basis point cut in interest rates by the end of the year. This is putting downward pressure on the dollar, and a weaker dollar is bullish for gold. Technical analysis can provide valuable insights into gold's price direction. By studying charts and indicators, traders can identify support and resistance levels, as well as potential trend changes. Right now, gold is in overbought territory. The Relative Strength Index, or RSI, a momentum indicator, is above 70. This suggests that a pullback could be in the cards. However, the trend is still your friend. Gold has broken out to new all-time highs. This is a bullish sign. The path of least resistance is up. Key resistance levels to watch are $3,245 and $3,250. A breakout above these levels could signal a move to $3,300 or even $3,550. On the downside, support can be found at $3,190 and $3,150. A drop below $3,100 would be a bearish development, potentially leading to a correction towards $2,936. Section 5. Central banks enter the fray. Central banks around the world are increasing their gold reserves. This is a major vote of confidence in the yellow metal. India and Poland have been particularly aggressive buyers, boosting their gold holdings by 206% year over year. This suggests that central banks are losing faith in fiat currencies like the US dollar. Even China, which had paused its gold purchases for the first time in 18 months, is expected to resume buying soon. The People's Bank of China, or PBOC, understands the importance of diversifying its reserves away from the dollar. This central bank buying spree is putting upward pressure on gold prices. It's also a sign of the times. Central banks are preparing for a future where gold plays a more prominent role in the international monetary system. Section 6. Riding the bull, respecting the bear. So how should investors play the gold market right now? It's important to have a plan, whether you're bullish or bearish. For the bulls, the strategy is simple: buy the dips. Look for pullbacks towards support levels as opportunities to add to your positions. A good entry point would be near $3,185, with a stop-loss order placed below $3,177. However, it's crucial to respect the possibility of a correction. The RSI is overbought and the market can't go up in a straight line forever. Bears could look to sell rallies that fail to break above $3,245, targeting a move back towards $3,100. A stop-loss order above $3,257 would limit potential losses. Section 7. Managing your golden bets. Risk management is essential in any market, especially one as volatile as gold. Here are a few tips to protect your capital. Never invest more than you can afford to lose. Gold can be a volatile asset. Be prepared for ups and downs. Use stop-loss orders. These orders automatically sell your position if the price falls below a certain level. This limits your downside risk. Diversify your portfolio. Don't put all your eggs in one basket. Invest in a mix of assets including stocks, bonds, and commodities. Section 8. The final verdict. Gold is at a critical juncture. The trade war, the Fed's policy decisions, and central bank buying patterns will all influence its direction. Technical analysis suggests that a pullback is possible, but the overall trend remains bullish. Investors need to be prepared for anything. Have a plan, manage your risk, and stay informed. The gold market is about to get even more interesting. Section 9. Disclaimer. This is not investment advice. I am not a financial advisor. Do your own research before making any investment decisions.